Planning to own a self-storage facility? You might want to think twice. The pitch everyone hears about this business: a fenced lot, a keypad gate, rows of steel units. No customers walking through a door, no employees needed most days, just people quietly handing over money each month for things they'll probably never open again. It's the closest thing to a boring wealth fantasy most people have. The fantasy skips one part, though. The fence and the buildings cost millions, and it can take years before a single one of those units is making you real money. So why do people still do it? Self-storage REITs, the big publicly traded operators, have delivered an average annual return of about 17.3% a year going back to 1994. That beats the S&P 500's 10.1% over the same stretch, and it's not particularly close. But building your own facility from scratch can run into the millions of dollars before a single customer signs a lease. And in the meantime, exactly zero of those dollars are coming back to you. So how does a business people brag about at backyard barbecues also require millions up front, with actual profit sometimes years away? That's the real question here. And the answer isn't really about the buildings. It's about a waiting game most people underestimate, and a pricing trick almost nobody outside the industry has ever heard of. The first cost, the one that hits before you've signed a single tenant, building or buying in requires millions, and the margin everyone quotes you isn't the one you'll take home. Let's start with what it costs to get in. Construction alone, just the metal building itself, runs somewhere between $25 and $75 per square foot in 2026, depending on whether it's climate-controlled and how many stories you're building. But that number is deceptive, because construction is only one line item. Once you add land, permits, paving, security systems, and the office, the real all-in cost for a proper facility climbs a lot higher. For a facility in the 50 to 60,000 square foot range, call it 500 units, give or take, all-in project costs commonly land somewhere around $2 million on the low end if you're converting an existing building instead of building new, and $8 to $12 million for a ground-up, climate-controlled build with land included. Most owners aren't paying that in cash. SBA 504 loans are the standard financing tool for exactly this kind of project. Now, you've probably heard that self-storage has insane margins. Numbers like 65 to 75% get thrown around constantly. And technically, that's true. But that's NOI, net operating income, the income before your mortgage payment. Once you factor in debt service on a facility you financed instead of paid for in cash, your actual take-home margin is a lot thinner than the number everyone quotes you. There's also a second way in that skips most of the risk we're about to talk about: buying a facility that's already up and running instead of building one from scratch. Self-storage cap rates have averaged around 5.8% recently, with the best Class A properties trading closer to 5% and more ordinary Class B facilities running more like 5.5 to 6.5%. Translate that into plain English. You're paying a premium for the fact that someone else already survived the hard part. Which brings us to what the hard part is. The hidden trap, the one that swallows the first 2 to 3 years. Your expenses start on day one, but your revenue doesn't catch up for years. A brand new self-storage facility doesn't fill up fast. Industry data puts the average time to reach stabilized occupancy, meaning 85 to 90% full, at 24 to 36 months. And according to the Self-Storage Association, that average has been getting worse, not better, climbing from around 30 months to 36 months in recent years. A typical 500-unit facility might only add 10 to 20 new tenants a month under normal conditions. Do the math on that, and you're looking at 2, sometimes 3 full years before your units are mostly full. But your expenses don't wait for your tenants to show up. The mortgage payment is due every single month starting on day one. So is insurance. So are your utilities and your staff. Revenue climbs slowly from zero while your costs are fixed from the very first day you open the gate. And if you happen to build in a market that's already oversupplied, which is a real risk in parts of the Sun Belt right now, That lease-up period can stretch even longer, while rental rates get squeezed by everyone else's empty units competing for the same tenants. Despite all of that, people stay in this business for one real reason. The demand itself is genuinely resilient. Industry people call it the 4 Ds: death, divorce, downsizing, and dislocation. Life falls apart in some way, and storage is where the stuff goes while people sort it out. That demand doesn't really care what interest rates are doing. But resilient demand and easy money are two different things, and the gap between them is exactly that 2 to 3 year window where your building is real, but your income isn't yet. The real engine, the one almost nobody outside the industry knows about, the money isn't in the rent you advertise, it's in the rent your existing tenants don't notice you raising. So if the buy-in is brutal and the lease-up is slow, how does anyone make real money here? This is where it gets interesting. Because the rent you see advertised online is almost never the rent existing tenants end up paying. Between the start of 2016 and the end of 2019, a fairly normal stretch for the industry, the advertised move-in rate for new customers actually fell by about 6%. Meanwhile, the average rate that existing tenants were already paying rose by nearly 10% over that same period. That's not a coincidence. It's a strategy. It's called an existing customer rate increase, or ECRI, and it works because moving your stuff out of a storage unit is a genuine pain. Most tenants will just accept a modestly higher bill rather than rent a truck and do it all over again somewhere else. That increase barely needs to be noticeable to matter. Raise the rent by just $10 a month across 200 tenants, and that's an extra $24,000 a year in pure profit. At a 6% cap rate, that single $10 bump adds roughly $400,000 to what the entire facility is worth on paper. And ECRIs aren't even the whole story. Most well-run facilities also sell tenant insurance or a protection plan, generating $8 to $15 per enrolled unit every month at 50 to 70% profit margin, often adding up to 15% of total revenue at facilities where more than half the tenants sign up. None of this shows up in the number people quote you when they say storage is easy money. It's the quiet mechanism underneath the whole business. It's also getting more valuable by the year, for a reason that has nothing to do with pricing tricks. The customer base is changing. Storage used to be something you rented for 6 months during a crisis and then left. Increasingly, especially among younger renters, it's becoming a subscription, somewhere to permanently offload stuff instead of paying for a bigger apartment. Average tenancy length for these renters is running 18 to 24 months instead of the old 6 to 12-month norm. Industry data pegs that as more than double the lifetime value of the same customer. None of this is a secret, and it isn't always popular. Aggressive ECRI practices have drawn real pushback in some markets. New York in particular has seen lawsuits over pricing tactics that critics say cross the line from smart revenue management into something closer to a bait and switch. So this isn't a playbook with zero limits. But used carefully, it's still the difference between owning a building that breaks even and one that builds real wealth. And it's exactly why somewhere between 40 and 70% of facilities nationwide are still run by small, independent owners who haven't systematized any of this yet. That gap is either an opportunity or a warning, depending on which side of it you're on. The real money in self-storage. Rent roll gets you in the door. Existing customer rate increases and tenant insurance are where the real profit lives. A $10 bump on 200 tenants is $24,000 a year and $400,000 in property value. That's not luck. That's the playbook every REIT already runs. You can see how seriously the big players take this. In 2026, Public Storage, the largest operator in the country, announced plans to acquire national storage affiliates in a deal worth roughly $10.5 billion. It's not an isolated move either. Total self-storage investment transaction volume hit $5.9 billion in 2025, already ahead of the entire prior year. This isn't a bet on buildings. It's a bet on exactly the playbook we just walked through. Pricing systems and scale, applied across thousands of facilities that mom-and-pop owners are still running on instinct. So let's run the two real outcomes. The optimistic case. You buy or build smart in a market that isn't already oversupplied. You hit stabilized occupancy close to the 2-year mark instead of 3. You run a disciplined ECRI program and get solid tenant insurance enrollment from day one. Your real after-debt service margin lands in a genuinely healthy range, and the property's value has climbed well past what you put into it. The realistic case. The market gets more competitive than you expected while you're leasing up. Stabilization takes the full 3 years, not 2. Interest rates move against you right when you need to refinance. Once debt service, taxes, and management costs are subtracted, industry estimates put realistic blended profit margins closer to 40%, not the 65 to 75% NOI figure that gets quoted at the top of every pitch deck. You're not losing money, but you're also not seeing real profit until year 3 or 4. And that gap between the good version and the rough version of this business is almost entirely decided by timing you don't fully control. So is it worth it? If you're picturing a check that shows up immediately, this isn't that. This is a business built for people with the patience and the capital reserves to survive 2 to 3 years of a facility that isn't profitable yet. There's a reassuring part, though. This isn't a business that tends to fail outright. Long-term survival rates for self-storage operators run in the 90 to 92% range, about as safe a bet as small business ownership gets. It just doesn't make you rich on the timeline the fantasy promises. For people with the patience for that trade, and who understand the rent roll is only half the business, self-storage really can be one of the most durable plays in real estate. Remember this: self-storage isn't passive income. It's patient income. The buy-in is real, the 2 to 3 year wait is real, and the margin everyone quotes you is bigger on paper than in your bank account. Survive the wait, run the pricing playbook, and it becomes one of the most durable plays in real estate.